Maverick's extensive guide to mutual funds investing framework. Introduction. Mutual funds are a popular investment vehicle that offer numerous advantages, including diversification, professional management, and liquidity. To optimize your mutual fund investments, it is crucial to understand the fundamentals and adhere to specific guidelines. This comprehensive guide provides detailed information, practical examples, and additional tips to help you better understand mutual funds and make informed decisions. 2. Key principles for mutual fund investing success. 1. Fix your finances first. Assess your overall financial situation, set goals, and prioritize other investments like paying off high-interest debt and contributing to tax-deductible retirement plans. 2. Focus on saving and regular investing. Develop the habit of consistently saving and investing in mutual funds, as this is more valuable than trying to pick the top-performing funds. 3. Hire conflict-free advisors. Seek assistance from advisors who sell their time and expertise, ensuring that they prioritize your best interests. 4. Consider the tax impact. Always evaluate the after-tax returns of your investments, as the returns you get to keep matter more than the pre-tax returns. 5. Prioritize overall happiness. Remember that a larger fund portfolio does not necessarily lead to increased happiness. 5. Invest in your health, family, and friends as well. Explore alternatives like exchange-traded funds, hedge funds, and individual stocks and bonds before investing in mutual funds. 3. Selecting mutual funds. 1. Accept that there are no guarantees. Even with logical and analytical decision-making, some funds may underperform. 1. Fund selection is not an exact science. Example: Vanguard and Fidelity are well known for offering a wide range of low-cost, high-quality mutual funds. Example: a fund with an expense ratio of 0.5% is more cost-effective than one with an expense ratio of 1.5%. 4. Don't rely solely on past performance. While historical performance is a factor, it should not be the only criterion when selecting funds. Example: the Vanguard S&P 500 Index Fund, VFIAX, is a popular index fund that tracks the performance of the S&P 500, such as U.S. and international stock funds and bond funds. If possible, use at least 2 funds within each category. Example: a balanced portfolio may include a U.S. stock fund, an international stock fund, a bond fund, and a real estate investment trust, REIT, fund. 7. Avoid guru predictions. No one can consistently predict mutual fund performance, and those who claim to have developed a sure win system are unlikely to share it. 8. Don't overestimate the value of finding top-performing funds. The best fund managers may only marginally outperform market averages each year. IV. Monitoring your funds and portfolio. 1. Maintain a long-term perspective. Review your fund performance monthly or semi-annually, as frequent monitoring may lead to impulsive decisions. Exercise patience, as market conditions tend to improve over time. Example: if you have chosen a well-researched fund that experiences a temporary downturn, use the opportunity to purchase more shares at a discounted price, as it is likely to recover in the long run. 3. Avoid market timing. Shifting money in and out of mutual funds based on news or predictions can negatively impact your investment returns. 3. Stay invested for the long term. Example: if you initially invested in a high-risk growth fund but now require a more conservative approach due to a life event, it may be time to shift some assets to a lower-risk bond fund. Example: compare a large-cap stock fund to the S&P 500 index rather than a bond index or a small-cap stock fund. V. Additional tips for mutual fund investing. This strategy allows you to purchase more shares when prices are low and fewer when prices are high, reducing the overall cost per share. Example: if you invest $500 per month, you will buy more shares when the share price is low, and fewer when it is high, which can help to lower the average cost of your shares. Example: if your target allocation is 60% stocks and 40% bonds, but due to market fluctuations your current allocation is 70% stocks and 30% bonds, you should rebalance by selling some stocks and buying bonds to achieve the desired ratio. Example: Conservative investors may prefer a higher allocation to bond funds, while aggressive investors might lean more toward stock funds. It is a valuable resource when researching potential investments. Short-term investors should avoid high-risk funds, while long-term investors can afford to take on more risk for potentially higher returns. Example: if you are investing for retirement and have 20+ years until you need the money, you may consider a more aggressive portfolio allocation. Consider the manager's history with the fund and their past successes. Example: a fund manager with a proven track record of outperforming their benchmark over the long term could be a positive sign for the fund's future performance. Adjust your portfolio accordingly to hedge against potential risks. Example: during periods of high inflation, you may want to allocate more of your portfolio to assets that perform well in such conditions, like inflation-protected bonds or stocks in sectors that benefit from inflation. Conclusion. Investing in mutual funds can be a rewarding experience when you follow the guidelines and additional tips provided. By ensuring that your personal finances are in order, selecting appropriate funds, and monitoring your investments with a long-term perspective, you can maximize your chances of success in mutual fund investing. Patience, discipline, and informed decision-making are vital to achieving your financial goals.